In this video, let's cover some of the best small cap ETFs for all market conditions. I will not only list these funds, but also go over some of their pros and cons. Also, all ETFs that I cover today are blend funds, meaning that they invest in a mix of growth and value stocks. And in my future videos, I will zoom in on value and growth ETFs in a small cap space. Before I proceed, let's understand why you would even want to have exposure to small cap stocks. The thing is that if you buy an S&P 500 ETF like VIOO, you get a tiny 1% exposure to small caps. With total stock market funds like VT, the exposure is a bit higher at 6%, still very low. For some investors, that's just not enough. As big companies like Nvidia get bigger, they take up more and more space in market indices. The small guys are getting squeezed out. The US stock market is currently peaking at its top 10 concentration at roughly 40%. In my previous video, I looked at the market concentration and concluded that it's at an all-time high. Concentration amplifies both gains and losses, and as recent sell-off in tech space showed, a few stocks that go down can take the entire broad market with them. And so that's one of the reasons to go for small cap stock exposure. Historically, US small cap stocks have outperformed large caps. Small companies tend to be more nimble on opportunities, especially during economic rebounds. In fact, there is an investing factor called size that economists have researched extensively. It says that small cap stocks tend to outperform large caps equities. But that was true up until about 2022. Since then, large cap stocks were ripping through all-time highs, and that was thanks to those few big tech stocks. But one can argue that small cap stocks can stage a rebound at some point too. Morningstar says that small cap stocks do especially well when the interest rates start to go down, which is more or less the case right now. And if the economic growth continues rolling, small cap stocks may see better days. But all this comes with a lot of caveats. Small caps are very risky. They don't have the same scale of capital and human resources as large corporations have. They also have probably weaker competitive advantage. On top of it, small stocks come with far larger trading costs, and that's a non-trivial issue for them. It is so important that Morningstar even factors in portfolio turnover when rating small cap ETFs. We may ask why. Because if the fund has to trade more often and trading costs are higher for small cap stocks, those trading costs will eventually get subtracted from the fund's returns, and that is separate from the fund's expense ratio. For instance, let's take a multi-billion ETFs like Vanguard that invest in small cap stocks. From time to time, it has to rebalance its portfolio, and then it either buys or sells small cap stocks, but with that, it can have material impact on stock prices of these stocks. In fact, even if they stagger those trading over several days, that still can be the case. The bid-ask spreads start to widen and will eventually may even distort stock prices for those small companies. Also, small caps don't get the same amount of attention from investors as large cap stocks do, and that can make them underappreciated and underpriced for quite some time, and that's a big negative. And that is something that I personally know from my own experience of investing in individual small cap stocks. So with those caveats aside, let's take a look at some of the best small cap blend funds. The first small cap ETF on my list is a VB by Vanguard. VB comes with a rock bottom fee of 0.05% and a gold medalist rating from Morningstar. Its recent portfolio turnover was 13%. VB invests in the bottom 85 to 98% of the US stock market. The fund weights its holdings by float-adjusted market cap. This ETF differs from other funds on my list as it casts a wider net across the small and mid-cap universe. For this reason, it invests more in mid-cap equities. The average allocation to mid-cap stocks for Morningstar small blend category is 9%. VB allocates 29%. So this ETF is not a pure play on small caps, so to speak. VB's average market cap for its holdings is $8.5 billion. That's way more than the category average and funds that I cover today. But sometimes VB may do well if a given stock graduates into a mid-cap category. That way, the fund may continue capturing the upside of that stock as a mid-cap one. Also, mid-cap stocks probably have less risk, given their size. As with many other small cap ETFs, VB holds a large number of stocks, currently over 1300. Its top 10 concentration is also very low at 4%. When it comes to sector allocations, VB is not too different from its category. Most of its holdings are in the industrial, financial services and technology sectors. The second small cap ETF is SPSM by State Street. SPSM charges 0.03% fee and has a gold medalist rating from Morningstar. Its last portfolio turnover reading stands at 21%. As the name implies, the fund holds 600 small cap stocks with a market cap between $1 and roughly $7 billion. Besides that, SPSM ETF filters stocks by their liquidity, but most importantly profitability, and a given stock must have demonstrated profitability over the last year as well as the last quarter. And this is very similar to the S&P 500 index. This rule has its pros and cons. It helps SPSM to focus on more stable companies, and that makes this fund closer to the value rather than a blend fund. In other words, there are fewer growth names in SPSM portfolio. The con of this approach is that SPSM will not include companies in small cap space that are unprofitable but with lots of growth. The fund will take a wait-and-see approach. It will only consider them once they turn a profit. Another interesting feature of SPSM is that it doesn't follow a preset schedule for rebalancing. The S&P 600 committee meets and decides when to rebalance. But at the same time, the fund may act really fast if a given stock graduates from its market cap limits of a small cap stock. SPSM is a pure play on small caps. Its share of microcap stocks is significant relative to its peers. The fund's average market cap is $3.4 billion, which is almost 2 times less than for its category. Those tiny microcap companies are especially risky and something to be aware of. But the fact that they are profitable is a big mitigating factor. SPSM holds roughly 600 stocks and has a top concentration at 8%. That's a bit higher compared to other ETFs, but still reasonable. Its sector allocations are not materially different from its peers. Again, financial, industrial and tech stocks account for almost half of its portfolio. The third fund on my list is SCHA by Schwab. SCHA charges a fee of 0.04% and has a silver medalist rating from Morningstar. The portfolio turnover is 11%. After liquidity and minimum market cap filters, anything small cap goes into the SCHA portfolio. In fact, among ETFs we cover today, it has one of the highest numbers of stocks in its portfolio at over 1700. SCHA provides one of the widest coverage of small cap stocks. The fund weighs its holdings by market cap. The top 10 concentration is low at 4%. A typical stock in SCHA's portfolio has about $4 billion in market cap. That's pretty low and comparable to SPSM. But SCHA does not apply profitability filter like what SPSM does. And for this reason, many unprofitable and riskier companies make it into its portfolio. And that's a downside, because it can make SCHA volatile, with larger drawdowns potentially in bear market episodes. This can also be partially visible in SCHA sector allocations. We see that it allocates a bit more to the healthcare sector. That's where many unprofitable biotech stocks reside. The fourth small cap ETF is FESM. It comes with a somewhat higher fee of 0.28% and a gold medalist rating from Morningstar. FESM is an active fund. It has people at Fidelity who manage stock picking. According to Fidelity, this ETF uses quantitative models to select small cap stocks. The model inputs include valuation, earnings growth, and other technical indicators. I generally dislike active ETFs. They look like black boxes from outside, and with that, you don't really know how they select their securities, and most importantly, how consistent that security selection is. In this regard, the gold medalist rating from Morningstar is a surprise to me, and probably the biggest factors behind it are Fidelity reputation as well as that quantitative approach to investing. The fund has a strong Fidelity management team too behind it. Plus, a more systematic quantitative approach can make stock picks more consistent. there's still a human factor involved, but FESM statistical models built and tested on data mitigate it. The average market cap in FESM's portfolio is around $3.2 billion, which is below its peers. Currently, this ETF has a small allocation to mid-cap stocks, but it is in line with its peers. The fund holds fewer holdings at around 600. Its top 10 concentration is also a bit higher at 9%. At the same time, the fund has a lot of churn in its portfolio. The turnover is one of the highest at 73%. As a result, FESM probably incurs a lot of trading costs. As for the sector allocations, the fund allocates more to the tech sector at 20%. It is lower than for the broad-based US stock market at over 30%. Still, if your goal is to diversify away from tech, that's something to watch out for. And the last ETF on my list is DFAS by Dimensional. The fund charges 0.27% fee and has a gold medalist rating from Morningstar. DFAS is also an active fund. The main reason for the gold rating is DFAS quantitative approach. In fact, it is pretty strict and based on solid research according to Morningstar. This ETF looks at the bottom 10% of the entire US stock market, and it filters out stocks that are too small and profitable or too expensive based on price-to-book ratio. Also, Dimensional added another important filter not long time ago. Namely, based on their research, they concluded that small-cap stocks with too high of a growth rates for assets tend to perform poorly, so DFAS steers clear of those stocks too. The result is a portfolio consisting of over 2,000 names with very low concentration of 3% at the top. Surprisingly, the portfolio turnover is 8%. That's very low for an active fund. Most of its holdings currently sit in small-cap stocks with an average market cap of $4.4 billion. Sector allocations are not too far off from peers. Financial, industrial, and tech stocks take over 50% exposure. If we compare total returns for these funds, here's what we see. FESM by Fidelity has done well in the last 3 and 5 years. The return difference is material. It is hard to say why. I did notice that FESM overweights small-cap growth stocks a little more relative to other funds. Another factor could be higher concentration at the top. It amplifies gains in good times. But if we start zooming out, other ETFs start to catch up. Of the bunch, SCHA performance is a bit spotty. It is either comparable or worse. SCHA concentrates on small cap space with no profitability filter in place. That could hammer it occasionally. If we look at standard deviations, all 5 funds tend to cluster around 20%. On a volatility-adjusted basis, VB and FESM have done well relative to peers. It is impressive for an active fund like FESM to do so well for so many years. Most likely its rule-based quantitative approach is behind this success. And here's a quick summary for you guys. As we can see, there is a mix of passive and active funds here. Morningstar rates them as either silver or gold. Active funds like FESM and DFAS come with a bit higher expense ratio. At the same time, not all funds provide pure play exposure to small cap stocks. VB ETF is a standout here. Likewise, some funds are more concentrated than others. FESM is the most concentrated of the 5, with the highest concentration in tech stocks. Also, not all funds filter their stocks by profitability. DFAS and SPSM do. I cannot tell for sure if that's the case for FESM. Likely they do take it into account. Filtering out unprofitable small-cap stocks can lower risk for the fund, but that come at the expense of dropping growth companies that can turn profit one day. Finally, I want to point out one important misconception about small-cap stocks. Many people think that they're dirt cheap right now. But that depends on how you look at it. For instance, here are the relative valuation multiples for small and large cap stocks. They're the usual PE, PB, and PS ratios. Small caps indeed look cheap, but we're missing context here. What about risk, profitability, and earnings growth? For instance, small cap stocks tend to have far lower returns on invested capital. It could be multiple times lower than for large caps. That tells us that high multiples for large caps could be justified. Let's look further. How about earnings growth rates? Large caps dominate again on a historic basis. Of course, the forecasts say that both small cap and large caps will be on par, but that's just that, someone's forecast. It could be wrong. And of course, don't forget the risk. I don't have really tangible numbers to back it up, But common sense says that small caps are probably riskier compared to large cap stocks for many reasons. So if we start to control for all these factors, then small cap stocks don't look as cheap as they are on the first look. And that, I guess, is my word of caution. I would not go all in on small cap stocks. There are reasons why they're cheap. But does it mean that an investor should skip on small cap ETFs and stocks altogether based on this observation? Not necessarily. Small cap stocks have the potential to do well under the right set of circumstances. If their profitability and growth rates improve, then the market may rotate into them. So as usual, it's a nuanced situation. By the way, guys, you probably know that I love and use Seeking Alpha for my videos. It is a great platform to research ETFs and stocks. I partner up with them, and if you use my link below, you will get 20% off your Seeking Alpha subscription until December 10. And that's all for this video. I hope it will help you make the right choice when it comes to small cap ETFs. Also, in my next video, I will take a look at small caps ETFs in the value and growth spaces. So stay tuned for that and subscribe for more. Thank you for watching, and I will see you at the next one.